there are two views that the finance minister might actually uh, take another year before she gets back to the path of fiscal consolidation and therefore peg next or the coming year's fiscal deficit to say around 6.5%. There's another view that now that tax collections are so buoyant, she will now get back very urgently to the path of fiscal consolidation, which she deserted for a couple of years because of the pandemic, and therefore the fiscal deficit projection is even closer to 6%. Which one would the market like more? Which of these two options would the market like more? And what kind of stocks would come to the fore in the event of each of these outcomes?
So I think, Udayan, I would like to call it as a credible fiscal consolidation. The path is what the market will like. So the 6% number, I think, will be welcomed by the market, so far as it's backed by credible estimates. We are in one of those rare years, and actually we have to go all the way back to 2006, where government had the luxury of choosing between fiscal consolidation and spending because of buoyancy in tax revenues. So it's been a while since India has had buoyancy in tax revenues, and that's a very good thing for the markets as well, because it allows the government to make a choice. Let's boost growth further, let's spend more money and delay fiscal consolidation for a year, or let's focus on getting to the path of normalization by consolidating the fisc with some credible numbers. I think that's the latter which the market will celebrate, because when you're spending in a growth recovery, then the risk is you invite inflation. Also, what that does, Udayan, is it actually restrains the RBI. Remember, the RBI also needs to exit, and we are expecting the RBI to hike the reverse repo rate in February and then follow it up with successive rate hikes. The Fed is on a hiking path, so the RBI can't stay far too behind. I mean, no doubt India's macro stability is a lot better than it used to be. But even then, the RBI can't stay too far behind the Fed. And if the government pursues a path which is a little bit more on the fiscal expansion side, then it does create a bit of a problem for the RBI. Now, on your second question, which I think is very interesting, is what rates? And I think this all actually points to the probability that financials deliver stellar outperformance. So the RBI is likely raising rates, which means the short end goes up, which means financials have higher yields on their assets. The liabilities reprice a lot later, so their margins expand. I reckon that after the recovery in economic activity, credit growth will follow. And we can all opine that credit costs may have peaked because profits are recovering now. So this is really, a situation which financials will really love. So I would expect that sector, which has not done so well, and you've been in the market very long, Udayan, and you know that bull markets in India have rarely been created without financials. In fact, it's hard to remember one. We have to go all the way back to the mid-90s when consumer staples drove it. So this has been a rare bull market which has not been built on outperformance by financials. So I think 2022 looks like to be a year of financials. Now, your second situation where the government chooses to spend money and not consolidate the fisc, I think will probably play into the hands of the consumer stocks. So that means more spending by the government, which I reckon will be in rural and infrastructure. So industrials and consumer stocks, I think, could do well. So those would be, I think, how the market would react. The market will probably like the first scenario more than the second.